Have you ever wondered why the UK tax system makes your life impossible once you start earning a little more money? That becomes very clear the moment you get close to the 90,000 VAT threshold. £1 over and suddenly you owe thousands in extra tax you never planned for. Why the VAT threshold is such a trap, what really happens when you cross 90,000, and most importantly, the smartest ways to handle VAT once you're in it. Let's start by looking at just how brutal the VAT threshold can be. Imagine two businesses. Drone Solutions Limited, a VAT-registered business that makes 100,000 in sales, and Marcus Engineering, earning just under the line at 89,000. On paper, the VAT-registered business looks better off because it makes more money. But in reality, they have just appointed a silent business partner called HMRC. This partner doesn't do any work, but still takes 20% of all your sales. So even though the VAT-registered business earns more on paper, they end up with less money in the pocket. But the worst part is that to make the same amount as they did before, Drone Solutions Limited must now raise their prices by 20% just to cover the VAT they need to collect and pass on to HMRC. Suddenly, Marcus Engineering starts to look very appealing because he doesn't have to pay 20% to HMRC and keep the prices lower. So guess who the client's going to pick? They don't care that it's VAT, they just see you as more expensive. That's how damaging this system can be, especially if your clients are not VAT registered businesses themselves and need to pay this extra cost. So now you have two options. You either absorb the extra 20% to stay competitive, or you risk losing clients by raising prices. That doesn't feel like a level playing field, more like a system that's designed to slow you down. But it gets worse, because the VAT threshold has been frozen at 90,000 for years, and it's not clear what the government plans to do with it. That means more and more businesses will have to register without necessarily being any bigger or more profitable. And here's what many people forget. You cross the VAT threshold once your turnover exceeds £90,000 in any 12-month period, which means one busy season or a big contract can tip you over without you even realizing. And when you're registered in the system, you have to include VAT in the price of every sale you make, keep detailed records of the VAT you charge customers and the VAT you paid on your expenses, so you can finally calculate the difference and pay HMRC their cut. This is when you realize you're not just running your business anymore. You're managing HMRC's paperwork for them for free. You need Making Tax digital compatible software, you need to file quarterly returns, and for many businesses that means more admin costs, more software fees, and often more accountant fees too. That's why the government estimates they lose around £350 million in tax from businesses deliberately capping their turnover to less than 90,000. So after hearing all that, the natural question is, should you even cross the VAT threshold at all? The honest answer, it depends on your ambition. You can choose to cap yourself under 90,000 to avoid VAT, but if you want your business to grow beyond that, you can't stay stuck there forever. It's like driving a car with a limiter set at 60 miles per hour. You could go faster, but you choose not to, and eventually competitors overtake you. That's what happens when you slow down your business just to avoid VAT. But here's the thing, there are legitimate ways to avoid VAT registration without slowing down your business. One of them is incorporation. Moving from sole trader to a limited company creates a new legal entity with a fresh VAT clock. Just make sure you don't operate as a sole trader and limited company at the same time just to avoid VAT. HMRC will see right through it and you get yourself in serious trouble. It's important to speak to an accountant whether incorporation makes sense for you, as it's a very important decision. If VAT is unavoidable, however, you could start adjusting your prices up now to reflect what they will be with VAT included. That way, when you do register, your clients aren't hit with a sudden 20% shock. Plus, you can test how price sensitive your clients are. Just remember, don't make it look like you're charging VAT before you're actually registered, because that would be illegal. The truth is, once you're in the VAT system, one wrong move can damage your cash flow and put your entire business at risk. And if you don't have a plan, survival becomes highly unlikely. Once you're VAT registered, the speed limiter is off. You're on the motorway driving at full speed with everyone else. But here's the catch. HMRC built this motorway and it's full of potholes and little traps. So if you want to avoid breaking your car and losing all your money, this is how you need to plan your journey. First, Consider the flat rate scheme. HMRC promotes it as a simpler option for smaller businesses because it cuts down on admin. This is how it works. Imagine you're a waiter in a restaurant. Every time you serve a table, you collect 20% service charge from each client. Normally, you would hand the entire service charge straight to the boss, who is waiting for you at the back, and you don't get to keep a single penny. But under the flat rate scheme, the boss says, "You don't have to give me the whole 20% service charge, just give me 14% instead and keep the rest." So the customer still pays the full 20%, but you only pass on 14% to your boss, and you get to keep the difference. That's your flat rate percentage. But the catch is that every waiter has a different flat rate percentage. The lower it is, the better the deal is for you. And that's how it works in real life. You still charge your clients 20% VAT, but you only pay a fixed percentage to HMRC depending on your sector. The catch is you can't reclaim VAT on most purchases, only on certain capital items if their value is more than £2,000. That means if you buy a lot of things for your business, you can reclaim the VAT on most of them. That's the trade-off with the flat rate scheme. It keeps things simple, but limits what you can reclaim day to day. The good news is that when you first register, you can still claim VAT back on items you've already purchased for up to 4 years before registration, provided you still use them in your business. In my experience, many business owners miss out on a massive refund simply because no one explained them these rules exist. But getting money back is only half the battle. The real danger comes when HMRC asks for the 20% cut before your client has even paid your invoice. And that's where the choice between cash accounting and invoice accounting decides whether you stay in control of your cash or whether HMRC gets paid before you do. Invoice accounting is like paying Amazon the moment you place an order, even though you haven't received your parcel yet. In other words, you become liable for VAT to the taxman as soon as you raise the invoice to your client, even if he ghosts you and only pays after months of chasing. On the other hand, cash accounting is like paying for the parcel once it's delivered to your address, or in other words, you only become liable for VAT when the client actually pays you. That is a lifesaver if you experience many late payers. But even with perfect cash flow, you still hit a wall if most of your clients are consumers. They can't reclaim VAT, which means every job you quote looks 20% higher than the guy who isn't registered. But if you can pivot part of your customer base to other businesses, suddenly VAT becomes less of an issue because they can reclaim it and it doesn't represent a true cost to them. But no matter who your clients are, the same problem keeps coming back, treating VAT money like their extra profit in the bank instead of what it really is, a tax bill waiting to hit. The moment that money lands, part of it already belongs to HMRC. Spend it like it's profit, and you'll be scrambling at the end of the quarter, wondering how to pay a bill you should have seen coming. The smart move is to park it in a separate account the moment that money comes in. HMRC is not going to forget about the 20%, and the only way to stay in control is to be ready before they come knocking. So yes, you can survive the VAT motorway if you plan your journey, but don't think the battle with HMRC ends there. The moment you take money out of your business, they're waiting again with another trap. So watch this video next, where I'll show you how to pay yourself from a limited company without handing thousands more back to HMRC in payroll taxes.